Rob's Child. Nothing I say is investment advice. I have no intention to replace any content of security analysis, but to open it for discussion. This episode is on Chapter 41, titled Low-Priced Common Stocks, the analysis of the source of income. I found this chapter to be a pretty easy read with a few good points to get out of it. The first relevant point, he discusses a few irrelevant points about the price of a stock, if it's, specific prices and how that relates to the value of the company. And it has a little less relevance, although there is somewhat relevance to that today, seeing as though stocks priced under $1 can't be on they can't be traded on certain exchanges, for example. But the first big point from this chapter is that when you have a stock that has a very large price compared to something that has a smaller price gives, first of all, a little bit more liquidity. And that's kind of a point that he doesn't say directly here, but it's a point I kind of derive from this whole discussion. I found interesting, he shared a survey done, a study on low-priced, speculative, and diversified stocks, that they perform better from a trough to better times and have less of a downturn there afterwards, apparently. And so when markets are depressed, it's better to look for low-priced stocks compared to stocks that simply have a higher price. And we're talking in numerical values. A stock worth $600 a share tends to not be able to gain as much value in a bull market of whatever sort, compared to something that is like a $10 stock. And it's simply having that price difference. And like I said, I think it has more to do with liquidity. But then also, like I said, apparently they have less downside in depressed conditions, and this is in 1940. Things may have changed since then to some degree. Next part I wanted to discuss is why, even though that's said, you got to be careful, because he says, he doesn't even say that it happens, but he says why buyers of low-priced stocks oftentimes lose money. And apparently, in this time, you'd have sellers of stocks trying to push stocks on people to sell them. And a lot of times this was quite unscrupulous, because the sellers were selling these because the company or people and the parties involved were trying to dump their shares before they knew that they were going to become bankrupt, or they were going to lose everything. And so there's a history in this period where people were buying these supposedly super cheap stocks, and they were bad stocks, and so you would lose everything in these kinds of things. And then he says, and on the opposite side, when you have depressed stocks that nobody is trying to sell, it's like, the hidden ones would have this hidden value, because no one would be trying to dump them. They knew that the owners and the insiders knew that these still had value, so why bother try to push it on people when you can just buy more of it yourself. And so insolvency stocks, we can call them. When I first started getting into stocks, I got tricked into this myself. But like I've said in other episodes talking about this book, when you see a market cap that has a relative market cap value of several trillions of dollars, and now the whole company is worth only $50 million. That's a company that's just pumping out, that's just selling stocks nonstop. This isn't, a cheap stock because it's going to go right back up to $1 trillion market cap. This is a, for all intensive purposes, a scam, I would call it. And I think that relates to what he discusses here. And then we have the 3 pseudo low prices, so supposedly low price when it was actually worthless, examining 3 examples of a history of a mining company, and then a liquor company and an airplane stock, or some examples. And then we go through a section that tries, like I said, discussing a genuine low price versus a pseudo low price, the ones that are being pushed out onto the public that aren't actually worth anything. And then if there's no pressure to buy it in this time, that's when you knew you were buying they helped you be able to find a underpriced stock that would easily gain its value back. Now we have a little section next on companies that, he talked about in the last chapter that, a company that has no bonded debt doesn't have as much leverage on the stock side of it. However, there still are going to be cases where it's so low to the earnings that it's another great deal. The stock scavenger, it's like a scavenger hunt. And that's just another way to get something that is undervalued. And then he has an example of, it's an example of the rental cost of a company that has purely common stock. So they're paying out rental instead of maybe owning the property and having to pay interest on the money they borrowed from the bank instead of paying the rent. And so he has an example of 2 companies side by side that shows that they end up having equal situations, even though one of them has seniors and the other one doesn't, because of rental costs. And then we have a section discussing how unusually operating or production costs can be the equivalent of having a lot of bonded debt, or even an excessive amount of bonded debt. And so the way this works, he uses a hypothetical example and compares especially B and C having equally less profit because of higher amount of bonded debt or a higher operating cost. So B having a lot of seniors, C having higher operating costs compared to A, which didn't have either of those. They just had more profits. But then we have a bigger point here, is that the operating cost, you think naturally like a higher operating cost for being able to make profit is just flat out not good for owning a stock, but actually it ends up leveraging the stock in the same way that bonds can leverage a stock by the fact that if the price of the commodity goes up, the leftover, the increase of the leftover money increases a lot more than if you were holding stock on the full amount. And so it's I found that to be super interesting, and it ended up like in this example he uses 300%, and so it's like it's like a triple leveraged stock compared to company number letter A, B and C equally having that triple leverage to it. So that was a really cool point to read. When you're looking at a company that has higher operating costs, from a stockholder's perspective, you can think of that as simply giving leverage to the value of the stock. Then we have a section, we have a little title here, The Sources of Income. And he discusses he discusses a lot of these points earlier in the book and kind of reiterates them in the light of looking at the stock side of the business. And so, point is that different types of industries typically have different types of multipliers, and this is still true today. And he notes very smartly here that this changes over time. So just because your average water company trades at a PE of 12 today, that doesn't mean that it's going to stay that way forever. And we'll say, and then let's say technology is trading at a PE of 200. Imagine that reversing, and then everyone wanting, to have that more secure, that security being worth more, and then all of a sudden you have water companies doubling their stock price and having a PE ratio of 24, and technology, suddenly everybody losing hope in it and having it go down to 7 PE ratio. And so, and a great example of this is that he brings up here from this time period is how railroads were considered to be so secure for so long that it entailed a higher PE ratio because of the security of it. And, that didn't work out very well for a lot of people. And then he mentions how entrenched industrials were able to maintain earnings in the Great Depression. And that's part of the sources of income point there. And then he makes a point. He says straight up here, and we mentioned this in a chapter or two ago, no matter what, PE over 20 is outside of investment range. As soon as you're above 20, you're adding at least a speculative element to having capital appreciation along with acceptable return, maybe on dividends or whatever. And he says, especially when you're considering, especially when you're considering the shifts of industry type valuations. I don't know if he said that or I think he might have said that in there. But the point is consider that. Consider, a lot of tech companies. I mean, as of today, right now, November 2023, I was just looking at Amazon stock trading at a PE of 73, and it's maintained this for like 10 years, but we also haven't had a real full business cycle flush out, bad debt. And, to think that 73 PE ratio is like, yeah, we'll just keep going with this. And it's like, for how long? And the fact it can go down as low as 7, it's scary, actually, when you think about that. Like I mentioned earlier in this video. But moving on, he goes through 2 more examples of crazy cheap stocks because of... Sorry, I skipped ahead. Okay, so we have a new section that goes over another area of dirt cheap stocks. Basically finding companies that are tricking people into thinking that, to some degree, that, they're losing, their earnings are going down because they're losing business, or, maybe the business isn't going good, the company's not doing good, but they have income coming from other places that are outside of their business. And in the end of all of this, he mentions how, what are these companies? Why are these companies doing this in the first place? Why do you have a pipeline company that earns a ton of its income from Liberty bonds? What is that? That's not a pipeline company. And rentals were the 2 examples. And he says, this is a good thing to be able to find and take advantage of. One example that comes to my mind is MicroStrategy having a Bitcoin element to it, but also another business side, multi-business kind of a thing. They have income from different areas. I mean, a lot of the big tech companies have that too. All these big tech companies that are relying on, cloud. The big thing is cloud services now. Having your data stored in their facilities. But that's a little different. But he's talking about mostly like companies that are deriving their income from something other than what you think is their business necessarily. Maybe if like a copper miner company is just like loading up on treasury bonds and they're, making all this money. So that can present an opportunity. All of a sudden the company is worth like less than the value of the treasury bonds they're holding, and you can take advantage of that. But again, he says in all three of these examples, they were rightfully fixed, as in the companies eventually got rid of the stuff that was clouding what the company was really about, because it didn't really make sense what they were doing before. And that is the end of chapter 41 and the end of part 3 of the entire book. And that's all I have on chapter 41. Hope you enjoyed. Rob's Child.